Welcome back to Rockstock Channel. It is Monday, November 18th, and we have back on the podcast favored guest of ours, Matt Fernley, based in London. Matt is a highly regarded equity analyst for a very long period of time, worked on the sell side, now works on the buy side at Westbeck Volta Fund, but also publishes regularly in the Battery Materials Review. Analysis across the supply chain. Also has a good podcast with Cormac O'Lear called the Recharge Podcast. We'd encourage you to listen to that. If you want to follow Matt, you could follow him on X at Review Battery, but he posts even more on LinkedIn. And the catalyst for this interview was a somewhat controversial LinkedIn post, which you have now turned into a more substantial blog following a very significant and important site visit you undertook in China to get a sense of China lepidolite operations, as well as African, and other sources of spodumene supply. We're going to get into that in about 8 or 10 minutes, but we first wanted to talk a little bit about graphite. I was in Los Angeles at the Benchmark Week conference while you and Rodney were at the one-to-one conference in London last week, but I had an opportunity to catch up with a number of graphite companies. There was Nouveau Monde was there. I met with Tolga, which recently received an investment from SQM for their lithium operations. I met Renascore, who I had never met with before, but has an interesting project. And I also met with Syra, pretty much the largest or the main publicly listed producer, of graphite. So I just checking in after 2 years of in the doldrums, for graphite. Graphite got an exception, from the IRA, a reprieve, for 2 years. So that was kind of a disappointment, actually, to a lot of the graphite players. But if you could just share some update thoughts on the graphite market for 5 or 8 minutes, and then we'll go into your lithium commentary.
Yeah, I mean, I think with graphite, it's a difficult market. I mean, it genuinely is a two-tier market. So we've obviously got the upstream side of it, the mining, the graphite concentration, and then we've got the midstream side. Over the last 18 to 24 months, as you said, Howard, the graphite price has not really been going in the right direction from our point of view. This year, it's sort of stabilized a little bit over the last sort of 3 or 4 months or so, but it's not really rising. And obviously, the reason for that is we saw a fair amount of artificial graphite capacity going on in China over the last couple of years. And Chinese supply, both at the upstream and the midstream level, is pretty robust. I mean, the graphite story, from our point of view as Western investors, Western consultants, is really about the onshoring thematic and the development of supply chains ex-China. And while I'm not overly bullish, shall we say, about the very upstream part of the market, I still remain pretty bullish on the midstream part of the market, where we just do have a huge shortage of projects to come on at such time as these cell manufacturing facilities do come in the West, and graphite gets bonged out by local tariffs. But the big issue over the last sort of 2 to 3 years or so has been, because of the low prices, the market values of these companies has dropped away, and it has become increasingly difficult for them to raise money to install these midstream projects. And that's really the situation we're in now, where probably there is one graphite company in the whole global sector which is probably investment grade, i.e. large enough for institutional investors to invest in. And the rest of them are probably sub $500 million market cap, and sometimes a lot less than that. And obviously it's very difficult with that sort of market capitalization to raise enough money to build a material midstream project. So that's the situation we're in the graphite space. The longer that this difficulty of raising money continues, the bigger the gap's going to be when it starts to emerge in the Western world.
Okay, great. So, bottom line is the world is still nearly 100% reliant on graphite from China, and that's a geopolitical risk. So, projects need to be developed ex China. I noticed in the US there were a number of awards from the Department of Energy to a number of kind of midstream. Those were more kind of private companies,
Yeah, I
and they
mean,
were
I
more
think
they're
the
more
focus, yeah, synthetic graphite, silicon anode. So note that silicon anode is still silicon carbon anode for the most part. So you still got to, source graphitized material. But we really do have a big emerging issue in the West insofar as we just don't have enough of these midstream projects really even underway. I mean, there's one major spherical graphite project underway in the US and at commercial scale. And apart from that, there's nothing else.
right. Well, GM and Panasonic recently invested in Nouveau Monde. I guess earlier this year, GM made a big splash, in the lithium space. I want to talk to you about that toward the end of this discussion because you did indicate you will talk a little bit about like lepidolite as mica mines and softer rock than hard rock. Okay, Matt. So let's turn to lithium. You have a new article out, a free blog. I'd encourage everyone to read that. And you're always very good with having your cover pictures. And here you had kind of head in the sand itis, but head in the sand. But I recall, I think you used a similar visual here to describe Western OEMs a few years ago with their heads in the sand. And you were talking about structural deficits of lithium as far as the eye can see. And, the OEMs needed to write big checks, right, to get enough lithium supply. So that shifted, to the beginning of this year with a big oops was your title, just to keep us all honest
Yeah.
here. I remember
To
September.
be fair, while the Western OEMs didn't write big checks, the Chinese did write big checks and got
Yes.
around the structural shortage that way. So at least somebody wrote big checks, which was what we were saying needed to happen, but it wasn't quite who we were expecting to write the checks.
That is true. So in September of last year, I went to an Eagles concert and I wrote, take it to the limit one more time. I thought we would have one more rally at the end of last year. And you quickly replied in September when I said that, oh, there's a lot of African supply coming. So you were starting to kind of get bearish there. Goldman Sachs, people said, didn't believe and they were wrong. They were overly optimistic, right? Like we've overshot their 11,000 on the downside and it's been, going, a fair bit longer, than we thought.
Well,
You have
to,
had,
to be fair, Goldman's were negative on supply but positive on demand. What actually happened was supply wasn't as strong as they were forecasting, but demand was considerably weaker. So they got the right call, but possibly for slightly the wrong reasons.
okay. As I read it, though, they were very optimistic on how much supply could come out of
Out of China. Yeah.
Zimbabwe
Yeah.
and out of China lepidolite. And you commented a few months ago about like these Gen 3 lepidolites had much lower costs. Like earlier this year, we were saying that I don't know the cost, the conversion costs were much higher, and you said, well, no, there's byproducts. They've gotten better at it. Anyway, you've just visited China. A problem in this market is as well that China is very opaque. A lot of private companies. Africa is very opaque. A lot of private companies, and then so you get blindsided by all this. But then there's also an argument out there. It's like, oh yeah, but you can't believe what you're being told in China, right? Or SMM, which is a Shanghai metals market. This is a China dominated market, and there's no question that China like has interest to kind of manipulate things, but there's also like to not, what do you believe? So anyway, so you went straight to visit
horse's
site. I
mouth.
think it was a UBS, site visit. Okay. And, so what did the horse's mouth tell you? And, you know, can we believe it?
Yeah, I mean, I think the horse's mouth told us what I kind of had expected the horse's mouth to tell us over based on the evidence that we've seen over the last sort of 6 to 9 months, which was that the Chinese had lower operating costs than perhaps we had appreciated, both on the mining side and on the refining side. And that the Chinese operations in Africa also had lower operating costs than perhaps we had appreciated. Um, and I've spoken to Rodney about the African operations on many occasions, and the thing that always worried us about the African operations was the infrastructure, and not so much the operating cost there, but the cost of getting out of Africa and over to China. And it's clear that the Chinese are enjoying lower transportation costs than perhaps we had expected. And some of that in the Zimbabwean operations comes about because instead of going out through South Africa, which is what they were doing initially, they're now going out through Beira in Mozambique, which is much closer to the mining area, and reduces the amount of borders and the amount of distance it's got to be transported. So that's one of the reasons why the Chinese transportation cost is a bit lower than we're anticipating. But really, I sat down with probably 8 or 9 lithium companies and multiple lithium analysts while I was out there and in the weeks before I went there. And the word was basically the same. It's costing us between 70 and 90,000 renminbi per ton integrated to produce lithium carbonate or lithium hydroxide in China. That is materially below what it's costing the Western Australian hard rock producers who are selling non-integrated into China. So that was really the primary takeaway.
I mean, the reality is if supply keeps coming at these low prices, then there is some credibility around the cross-subsidy argument within CATL, or these operations can, survive, get funding, do whatever they're going to do. So this is the reality, I guess, and this is what you raised is in Australia think, well, someone else is going to cave first because they are uneconomic and eventually they'll go and we'll keep going. But what we've seen now is a stubbornly high supply, even though there's some margins coming out of those various jurisdictions. We're still seeing, even with some good EV sales numbers, supply keep coming.
Yeah. I mean, obviously, we saw the CATL operation close down about 3 or 4 months ago. That has operation costs around 90,000 renminbi a ton. That's a lepidolite operation in Jiangxi province. But, talking to the bulk of the lepidolite miners, converters in that area, you're talking about costs between 70,000 and 80,000 renminbi a ton. And obviously, the GFEX futures, I think that went down to about $73,000 a ton. It's bounced back up now. But I say bounce back, it's had a bit of a dead cat bounce, should we say. It hasn't exactly returned to its
To
high.
kind of that number, it's
yeah.
See,
Yeah.
the contango has flattened. So the near to the long future, there's only about a 3,000 renminbi difference going out, whatever it is. So it's flattish, but it's around 80 and up.
I mean, I think the thing that worries me is how much supply can come back into the market if prices bounce materially off here. So, if prices go up to 90,000 renminbi a ton, does the CATL operation come back in? I've been told that it's on a sort of hot restart, so it could basically restart within a month if they pulled the trigger on that. So, that these are the things that we have to sort of deal with in the market at the moment, and the new normal, if you will, in lithium. For a long time, 2020 to 2022, there was clearly an undersupply in lithium. But what's become very clear over the last 12 to 18 months is there's a lot of lithium around. And, how easy is it to extract? Probably a little bit easier than we thought it was to extract. Certainly, if you're Chinese, the Western Australians haven't covered themselves in glory in the refinery area. But so I think that it is a difficult market at the moment. On my supply demand numbers, similar to Rodney's, I see a surplus market for the next couple of years, I think.
So let me just understand, though, in terms of the logic, operations are running down their resource, making no money.
You mean the ones in WA?
And also in China, if your costs are around 80, you're not making any money. So
yeah,
expensive to shut and put on care and maintenance, or what is the logic if you don't have a big resource?
I mean, I think they've got reasonably sized resources. One of the things that really surprised me is in Jiangxi province, I was under the impression that the mines would be quite disparate geographically, but actually the bulk of the mines are on one hill. It's effectively one ore body. There's 5 mines on the same hill, and then sort of concentrated spread around there, and then they're trucking the material 40 or 50 kilometers to the refinery. So, I don't think that shutting it down would be enormously high cost. But as we've seen in China over the last 10 to 15 years, people generally don't make the decision to close down assets unless they genuinely are hemorrhaging cash. If it's close to break even, they'll run them. It's only if it's way below break even that they'll cut it. I mean, to be fair, we're seeing that in Western Australia as well. I mean, I think there's probably only one mine in Western Australia that is, very profitable at current levels, and all of the other mines are running despite being either close to break even or loss making on an AISC basis.
You made a comment in your note, never bet against the Chinese, right? There's a saying here, don't bet against Elon. Elon, was talking about software margins in refining, a while ago. Clearly, there's software margins nowhere across the supply chain currently. There was for a short window of time. But you made reference to like what China has done in the nickel market twice, the aluminum market, the steel market. There's been this narrative for a long time that lithium is somehow special, is different, and that we should, not compare it to other things. I've compared it to iron ore, but it doesn't look, the iron ore argument looks less like it's happening, given that it's not an oligopoly, right? Of, 3 or 4 like huge mines, in the world, or 3 or 4 huge companies, and the capex is quite low. Is this, you're seeing oversupply, you say, for the next couple of years? Is that because these lepidolite mines that you're seeing and what you're hearing from Zimbabwe and other African places has just ample supply?
I mean, we always used to say, invest in the commodities where China is short and go short of the commodities where China is long. And the point about lithium in sort of 2019, 2020 was China was short of lithium. And what was very interesting was the core sources of lithium in the world were kind of Australia and Chile. And Chile was saying, well, no to new investment. And Australia was saying no to new Chinese investment. So we automatically assumed, well, the Chinese aren't going to be able to add supply. But the Chinese hadn't read the memo. So they added their own supply domestically in China, which we always knew was there. it had been used for the ceramics industry primarily. So we knew that lithium was there in China, but it had been seen as such high cost that it wasn't viable to develop it. And they also went in and explored other lithium occurrences elsewhere in the world, and they found quite a lot of it in Africa. And they effectively did what they've done in a number of other industries, which has put their capital into Africa and into China, and end up producing at lower costs, good product, reasonable product for much lower capex. And as a result of that, they undercut the industry. And this was something that we didn't really appreciate happening for a long time, and it really jumped out in the industry at the back end of 22 and into 23, for the reasons that you said earlier, that China is quite opaque, and it's very difficult to see new things emerging. But I think we have to adapt to the new reality now. We mustn't sort of stick our heads in the sand and say, these Chinese numbers are rubbish, or SMM's talking rubbish, or all of these Chinese analysts are talking rubbish. We have to understand that there is a new reality, that it is possible to produce lithium for these prices. And if that's the case, then we have to look at making investments in lithium through the cycle. So, there are assets out there that are able to produce profitably through the entire cycle. There are not many of them, but there are some. And that's where I think we should be focusing on our investments effectively.
And I want to ask about that in a minute, but how this whole concept, go long what China is short, right? Go long what Tesla is short, right? Keep it simple, stupid. Keep it spodumene, stupid. I mean, these have been mantras, which I've been saying since 2015. So is China short lithium?
No.
With a medium to long-term time horizon?
No.
So
we're
not even
talking
the raw material. Not even the raw material.
I mean, we're talking about lepidolite now. Obviously, there are these lepidolite operations.
No, I'm just asking you, like, it is. China doesn't have the highest quality assets. We know lithium's everywhere, right? Like we do know lithium's everywhere. But the thought was that the lepidolite operations were not scalable, right? Like to any meaningful degree.
Yeah.
And the Shanghai brines, require DLE, so they are.
Yeah. So newsflash, they are scalable, and there's also been some quite major discoveries of spodumene in Sichuan province in China as well. So there's a number of major companies that are developing assets there. It is a difficult place to operate. It's high altitude. It's about 4,000 meters. So think sort of Andes around Argentina. So it is a difficult place to operate. It's a difficult place to develop infrastructure. So it is going to take them a while to build assets there. Obviously, you've also got the salt lakes in China as well.
Now that match, not there, but the Tibetan brines.
Yeah. So
your thoughts on those? They seem to be higher grade.
Well, I haven't been to the Tibetan operations, so I couldn't tell you in enormous detail. But obviously, there is. We've known about the lower grade salt lakes for a while, and we know that the Chinese are applying a fair amount of DLE as well. But I don't think they're getting that. Well, I know that they're not getting a huge amount of production out of their salt lakes at the moment. I don't know where it could go, but certainly they do have hard rock assets in both lepidolite and in spodumene. And then they have obviously access to the mines that they operate in Africa as well. So, 4 or 5 mines in Zimbabwe, a mine in Mali, and possibly operations elsewhere in Africa that they're looking at. So domestically, maybe China is still short in lithium, but they have feet on assets in Argentina and in Africa, which makes China Inc., should we say, a little bit more balanced in lithium.
Like a GNP, you cover all of their access. So and then obviously South America with the brines for them as well, and Brazil is there. So Matt, you're going to have Howard reaching for the menorah blades here. So tell me, good news here. What can turn this around? Do we need to go lower to go higher, or how does this work? Do we need to?
Well, I think it's a pretty. I mean, having spent the last sort of 5 years saying lithium's not a commodity, it's a material. I think this is a bog standard commodity cycle. We overinvested in supply. Demand has been a little bit weaker than we expected. And, we're in a commodity down cycle. In 2 or 3 years, I would imagine we'll be starting to come out of it again.
Just to be clear on the definitions here, thing now in lithium is this: we will have a commodity cycle, but there isn't a rise in a structural deficit.
No. I mean, it's not, when we were sitting here 5 years ago talking about potentially a structural deficit because demand was growing at 25% year on year and there was no way that supply could keep up. I think it's changed in terms of how much supply, we could, or the industry could lay its hands on.
In terms of demand shocks, so is there a level? So I kind of have a level. I mean, what if ESS is as big as I think it can be and what CATL is talking about and so on? Is there a volume at which regardless of all the maneuvers, that supply becomes tight, or likely to see further discoveries and so on? And because lithium is new discoveries, can there be new discoveries that can displace second and third quartile projects on the cost curve that exist now?
I mean, I think there can be discoveries. I mean, there have been a lot of major discoveries in Quebec, for instance, that are probably not in most people's supply demand balances. In the northern part of Quebec, I mean, I personally think that those are probably, there's 3 or 4 assets up there which could easily be world-class assets, and could displace existing operations, should we say, going forward. But I mean, let's not take away from the fact that this industry is still growing at 15 to 20% per annum in terms of demand, and will continue to do so probably for the next 5 or 6 years. So I do think, I don't think it's all over in lithium. I just think it's relatively weak at the moment. There will be another period when we will have a supply-demand imbalance at some point, and prices will move. But I think I don't expect prices to sort of spike to the sort of levels we saw in the last cycle, because I think the industry is a lot bigger now. And there's the potential for idled supply to come back into the market.
Field and so on. Matt, so the $1 million question, 30, from here to 2030, where are we likely to see sort of the marginal cost? What's the marginal cost number?
Yeah, I mean, I think this is a really difficult question, and thanks for putting me on the spot. I have marginal costs around about sort of $15 a kilo, is my assumption. So $15 a kilo of lithium carbonate is my sort of assumption. And that is based on the potential for DLE operations to be successful. So if a couple of DLE operations are successful, I think $15 a kilo is a reasonable level. If DLE continues to be difficult, shall we say, then perhaps a marginal price, a couple of dollars a kilo higher, would be justified.
18 to 20, so we're not a million miles apart.
Yeah,
that's still meaningful though. 15 to 18 to 20.
I mean, it's still a long way, below where we were sort of 2 years ago. And
yeah, well, so are my Big Macs. It's just to say where it was like a couple of years ago. I don't think is like such that relevant an argument. I mean, sure, iron ore and oil and other commodities haven't increased like as much as lithium has, but a lot of groceries have, and other, the cost of
I mean,
these operations ex
to be
China have
fair,
gone up
5
quite
or
a bit.
6 years ago, we probably had the long-term price around about $6 a kilo. So, I'm still more than double where we were before the last cycle. But
But
yeah,
that's a little disingenuous, because if you look at the NPVs or whatever it costs, that we've come
well, yeah. So the
since
valuations have come up
pre-pandemic.
as well. Yeah, yeah, yeah. No, that's fair. That's fair.
Matt, I want to just go into your note a little bit more, because you really basically saying Western Australia ex Greenbushes are the high cost producer because they're a high energy cost, high labor cost, and they have inferior ore, with mica and iron in it, from a Western Australia
And
perspective.
most importantly, smaller spodumene crystals. That's key as well.
Right. So you were basically saying if you could do DMS only in Brazil, in Ghana, and Quebec, those areas are going to have a competitive advantage to Western Australia.
Yeah, because if you look at the Western Australian power prices, it's just below 20 US cents a kilowatt hour. If you look at the Quebec prices, probably just over 6 cents a kilowatt hour. And there's various stuff in between. I've got a chart in the blog about that. But the point is, if you do DMS only, you're grinding the material. Sorry, you're crushing the material only. You don't have to grind it. So you're crushing it to millimeter size. Whereas if you have to float it, you have to grind it really fine to micron size. And the key point about this is it's hard rock. It's really hard material, spodumene rocks, spodumene pegmatites. So, the cost of having to grind it is so much more significant in terms of power demand. And obviously, if your power costs are so much higher as well, that's a double whammy. So that's really where I'm coming from on that contention.
Okay. So the ore is better because it's coarser and it could be DMS only in these locations. So, and you do have a good note on how to invest in hard rock lithium. I would encourage you guys to read that, but DMS only. But interestingly, Minres, Chris Ellison, said he was so happy. He kind of like commented that like Bald Hill is just like DMS only, and he doesn't have to do flotation like he has to do at Mount Marion and Wagina. But the first one he turned off was Bald Hill last week. So, and that looked actually to be lower cost than Mount Marion and Wagina. I'm speculating that's because he has Ganfeng as a partner and Albemarle as a partner, and to turn either of those off, he would need their consent, and they probably didn't consent to that. In my view, Ganfeng is waiting for Mali Goulamina, to become their base load of supply, but it's not yet there 100%. It's not fully ramped up, and considering Resolute Mining just got shaken down, $150 million. I don't know. The supply will probably come out of Goulamina, but Mali is a difficult place to do business. But I'm just wondering if that factored into the kind of Ganfeng Minres discussion. At present, Rodney said if they turn off Mount Marion, right there we can go back into undersupply. Right? That's in one fell swoop. So kind of sort of rooting for that. But before we talk about other lithium types, we had YJ Lee on the podcast a little while ago, and I met with another very smart analyst in New York who's played the lithium cycle, and it was their view that by 2026, I think Joe Lowry even suggested this, we could start seeing $30,000-$40,000 again on lithium. So to say we're not going to go back as high as we were, okay, whatever, 80,000, I don't think anyone thinks about that, but when you say the next cycle, it's a commodity cycle, it's a commodity. Do you think 30, 40, is possible, and in what time frame? Or, it doesn't overshoot. If you think $15,000 is the marginal cost, right? Going to 30,000 is a huge overshoot. Do you think that's possible? Or you think, the next cycle, all this latent supply just comes on and it mutes the price rise?
I think 30 odd is definitely doable. I mean, if you look at, in a normal cycle, yeah, prices can double. They can go up by more than that in a normal cyclical recovery. So I think $30,000 a ton, $30 a kilo is very viable. In terms of the timing, it's kind of how long is a piece of string? Because if we see more capacity shuts, then obviously it takes less time before the market's in deficit. But if we see guys continuing to overproduce, then obviously they're building up inventories. Those inventories have got to get worked through before we go into a deficit market. So it's kind of how long is this piece of string? We need to see more capacity cuts before we can start to talk about the market sort of turning around. On my numbers at the moment, I don't have a deficit before 27. But if we see more shutdowns, it's possible, yeah.
Okay, and these are, you can never know what a demand surprise might result in. And we do have a new president in the US. We're not going to talk so much about that with you. It's still very, fresh. Who knows? Elon, autonomous robo taxis, new vehicles coming on stream.
I think the other thing that possibly has caught some people out on the demand side this year is the rising share of plug-in hybrids as opposed to BEVs, because obviously your plug-in hybrid battery is much smaller than your BEV battery. So even though the Chinese EV sales growth has been pretty robust, with 40 to 50% of that is as plug-in hybrids. And anyway, Chinese BEV batteries are much, much smaller than US BEV batteries anyway. The impact in terms of lithium demand hasn't been as high. So I think, when we talk about demand, we have to be aware of the share of plug-in hybrids within the overall EV share. And Rodney and I are both very positive on ESS, but really for the next 4 or 5 years until ESS gets to be, a big enough share of the market, as it were, the market is still very much based on EVs. Demand is still very much focused on EV.
The same comment on my presentation at 1-to-1. Thing is, if you look at, it's not just the battery sizes, it's also the lithium intensity of LFP in China versus elsewhere, and then production scrappage for LFP cells versus production Northvolt and wherever else is very different. So that's I think
that's something that's really important to flag, because when you're producing ternary cells, you're probably only talking about a 60 to 70% battery yield. But when you're producing LFP cells, you could be talking about a 90 to 95% battery yield. So
that's my estimates as well. Yeah. So it's a big difference.
Really, really important, because you're not losing as much. And that has a big impact on balances.
The thing as well, it's a bit of an interesting thing for me, is that NIO is going to launch its first hybrid in 26. So this isn't a flash in the pan BYD thing. NIO is going from all EV PEV to including a plug-in hybrid in its lineup. The question is, look at EV exports out of China into rest of world. They are actually capturing quite a lot of what is meant to be that demand. Western OEMs, they're doing it with plug-in hybrids.
Yeah. And I think the really interesting thing about plug-in hybrids as well is that obviously plug-in hybrids quite an expensive technology, because you've got to have a an ICE engine in there. You also got to have a battery engine in there. But there's a new technology coming through. I say new technology, it's actually been around for a long time. Extended range electric vehicles, which is the fastest growing subset of electric vehicles in China. And I did a big article about this in BMR a couple of months ago, because it really is very exciting. So basically, with an extended range electric vehicle, it's a battery electric vehicle with a small electric motor in. So you have a smaller battery than you do in a BEV, but you have a small electric motor. The electric motor does not drive the drivetrain at all. It just charges the battery. And with an EREV, you can lower your emissions by about 90% from an ICE, but on a much smaller battery size. And you're talking ranges of probably 900 to 1,000 kilometers. So straight away, you're taking out the range issues that we've experienced with BEVs, but you're also taking out 90% of the CO2 emissions. So it's a really exciting technology that's just starting to come through again in China, and potentially could sort of take off elsewhere. But obviously the big question is, how much lithium do you lose by having smaller batteries, but do you gain anything back by having higher EREV sales? Obviously, it's really easy to calculate how much you lose, but not so easy to formulate, what higher EV sales could be.
You've just touched on something. Again, I asked this question at 1-to-1, or raised it, is, so China EV penetration is already consistently over 50% per month in the last few months. Point at which that growth, a lot of the analysts had quite low growth. It obviously has done far better this year given the split. Point in time, that's going to taper. I don't know, you look at some of the charts in second and third tier cities and some limitations. So these EVs are going to slow down at some point. US and Europe ready to pick up the slack to keep the demand up, because
I'm going to
Chinese
say because I think for me, the really exciting sector or region that nobody talks about is ROW. So rest of the world, excluding China, excluding the US, and excluding Europe, because ROW is growing at 35% year on year at the moment, and probably will become bigger than the US as an EV consuming region by the middle of next year. So, and we know that the Chinese are penetrating very strongly into that. I'm not going to call it a region.
What countries is ROW? What are the top 5 countries?
Thailand, Indonesia, Canada, Japan, Australia, India. India's a big one. So it's countries like that. There's a lot of Asian countries in there, and obviously China, because of its sphere of influence, is pushing strongly into the Asian countries, but also it's Latin America, and China is pushing really hard into Latin America, primarily because the Western OEMs, the Western EV makers, just haven't got the technology to compete in the mass market, and even Tesla, which is far and away the best. I don't think I'm blowing smoke up anybody to say that Tesla's the best Western EV maker, but they don't have any vehicles really in the mass market, and the Chinese do. So the Chinese are really cleaning up in, I'm not going to call it emerging markets, but rest of the world, ex-US and Europe.
These EREVs, that's very interesting. If you can go 900 kilometers with just a small gas tank and you're reducing 90% of the emissions, how big are those? What's the average battery pack size for that compared to
so currently most of the EREVs in the Chinese market are SUVs. So they're going to have like 40 kilowatt hour, 45 kilowatt hour battery packs, which is smaller than the average, just smaller than the average BEV pack for China.
Which the 50 was like the number I remember for a few years ago was the average.
Yeah, so they're about 60 now. But okay. Yeah, so it's a little bit, it's about sort of 25% smaller than the average BEV pack for China, but obviously a lot smaller than the average BEV pack in the US and Europe, which are much larger. But similarly, it's a slightly higher slightly larger battery than your average PHEV. So in China, your PHEV pack is about 25 kilowatt hours, and in the rest of the world, it's about 15 to 20 kilowatt hours.
Okay. And are these extended range EVs in China, are they largely LFP or all LFP?
Actually, you get a mixture. So because of the nature of the vehicles, which are often SUVs, you do get some ternary packs in there, but also LFP. And I think if you go into smaller vehicles like hatchbacks and sort of more mass market vehicles, you will move towards a higher share in LFP cells because of the
These
economics.
okay, thanks. These EREVs, they just were started launched like kind of like this year or last year?
Well, it's not a new technology. Like a lot of these technologies, they've been around for a while, but it's really started to take off over the last sort of 12 to 18 months. So Li Auto is a big proponent of them, and then AITO and various other Chinese companies. Some of the Western companies actually do have EREVs in their portfolios. I think BMW has an extended range vehicle. I think Ford has an extended range vehicle, though it's a commercial vehicle and not a passenger vehicle. But some of the Western companies do have the technology, but haven't rolled it out as fast as the Chinese have.
Okay. And going back to your note, you were kind of saying like a lot of the Australians were saying, the Africans or the Chinese or the Brazil has to shut down, but also, you have this argument from Albemarle and Arcadium, we can't invest in ex-China supply unless the price is 20,000, right? You're saying the price 15,000, that's dominated by China. It's like seems virtually impossible to stand up, a supply chain outside of China for the same cost, right? It just has to be higher.
I mean, this sort of touches on something that we see regularly right through the energy transition. If I put my hedge fund hat on, that the Chinese are able they have much lower capex costs than elsewhere in the world. So, if I build a battery factory in China and I build a battery factory in the US, it's probably going to cost 3 times as much in terms of capex per gigawatt hour in the US as in China. So, can we in the Western world genuinely compete with China when it comes back to onshoring? Or are we going to have to, and I'm going to be contentious here, but are we going to have to develop the two-tier pricing system that we sort of talked on and off about over the last sort of 4 or 5 years? And it seems to me that if we genuinely want to re-onshore these assets and secure our supply chains, we either have to subsidize these projects in the Western world, or we have to provide almost like a guaranteed offtake pricing structure so they can be economic. But yeah, I mean, it's very difficult, and I hear where the CEO of Albemarle and Arcadium are coming from, because that's exactly what I see in my numbers as well. We just can't do it in the West for the same price as they can do it in China. And I don't know if that's because we're over-speccing the plants, or what it is. But for some reason, the Chinese, and it's not just the case in lithium, it's been the case in nickel twice and aluminium and steel and whatever. For some reason, the Chinese are able to do it for less.
Is it lower environmental standards, lower labor costs in China?
Um,
Slave labor, like these are the types of things that politicians talk about.
yeah, I mean, I know politicians talk about that a lot. I mean, I don't think, I actually don't think the regulation in China is as weak as many people in the West suggest it is, which is not to say that that's always been the case. But the Chinese have really tightened up on their regulations over the last 2 to 3 years or so. So I think it's really the ability to, I call it a cookie cutter approach, to build multiple versions of effectively the same plant in multiple locations. And that's how they manage to lower. So basically it's a modular development. And we've always talked in the lithium market about things being really specialized. Like we can only run a lithium converter of 1 or 2 spodumene concentrates, and it's got to be, the quality of the material's got to be really highly spec'd if it's going into our plant, and then our plant's going to put out high quality, high spec material out the other end. It's not the case in China. I mean, I spoke to one converter. They've used something like 20 different types of spodumene concentrate, and they still put in a battery grade spec on the outside. So, I kind of wonder if the Chinese have jumped to level in terms of their processing, and we're still sort of mucking around at the sort of nursery end of the business in the West.
Well, you mentioned Western Australia refinery looks to be a bust. And we had Iggy Tan from Lithium Universe on here, and he was largely saying the skills don't exist, Western Australia, the chemical processing skills. They do exist, obviously, in China. They graduate lots and lots of people, and so there's critical mass of people and skills there. I think that level of skills exists in the United States. I think in Quebec, those skills exist. You were mentioning like energy costs are very high in WA. Like what percentage of cost or energy, right, for processing of lithium? Like how much of like Quebec's low cost is a competitive advantage there?
I couldn't give you the numbers on it without sort of going back to my models, but I mean, Quebec's low energy cost is always been seen as a competitive advantage for the lithium industry. Definitely. And I mean, Quebec's energy cost is sort of less than a third, probably a quarter of what it is in Western Australia. So it's definitely a competitive advantage. Yeah, I'd have to go back to my models
Okay,
to give you a
and labor
percentage.
costs are labor costs cheaper in Quebec compared to Western Australia?
Um, I would think so, probably in the northern part of Quebec. Yeah. I mean, the Western Australian mining industry has gone through a number of bull runs over the last sort of 5 to 10 years, and I think that's put quite a lot of pressure on labor costs. So yes, my gut feeling is that employment costs in Quebec could be less than they are in Western Australia.
Okay. I just want to go around kind of like the North American assets because your comment about lepidolite being soft mica just made me think about like Thacker Pass, right? They say the soft rock, lower cost to process. That's been financed. I mean, it looks like, I think that loan will get over the line and that's going to get into production or into construction. I've half jokingly called, Thacker Pass like America's lepidolite, right? I'm not, the ore is not exactly the same, but lepidolite is kind of like it's an epithet, to say it's like lepidolite. You assume it's like dirty, but you're making arguments that lepidolite's not so bad.
No, I mean, I don't think lepidolite's so bad. I mean, we are looking at quite a substantial difference in the chemistry between the two minerals. So, the Thacker-Pass, the sedimentary assets are clay minerals, and to break them out to get the lithium out of them, you basically have to roast it at a high temperature with sulfuric acid. So you're having to pump a lot of acid into those projects to get to get your
I'm
lithium out.
sorry. I think Thacker Pass is not roasting. I think the original plan was to roast, years ago, but
Yeah.
they have like a liquid, they're treating it like a brine.
Right. Okay. Well, I'm not au
You're
fait
not
with what's.
super
Yeah.
versed on Thacker Pass, it sounds like.
Yeah.
Okay.
Yeah.
Because I'm just thinking about like there's a lot of sedimentary deposits in Nevada, right? There's
Well, yeah. I mean, we're tracking like 10 or
Century
12 or
Lithium,
something. Yeah.
Arizona Lithium, Surge Minerals, Jindally. Elon Musk said there's more lithium in Nevada to for all the U.S. Lithium industry. So I think geographic concentration matters in standing up an industry, right? So in Arkansas, you have a lot of players there, and but you have a concentration of skills, among the oil majors. In Quebec, with Q2 has had a major discovery on top of Patriot's discovery, on top of Winsome's discovery, and then Moblon and Sayona, and there's Critical Elements, and North American Lithium is already producing and selling, to Tesla, that hard rock to hydroxide. So there's at least a concentration. So if you're going to stand up an industry, like have skills.
Well, I mean, I think particularly when you're talking about like spodumene, where infrastructure is core. So, with spodumene, you need, if you've got a couple of assets close together, then they can make use of a shared infrastructure solution. And I think, infrastructure and supply of raw materials is going to be key in all of these areas. I think in Nevada, the things that concern me personally are water availability for all of those projects. I mean, I know there's some for some of the projects, but for all of those projects. And also, one of the things that a lot of sulfur consultants have mentioned to me is availability of sulfuric acid, which could be a key issue if you're going to bring in all of those projects. But you're certainly potentially talking about three, producing focus, centers, silos, if you will, three lithium production silos that could develop in North America over the next 5 to 10 years.
There's more than that. There's the Salton Sea as a fourth. There's Leduc in Alberta as a fifth. There's North Dakota, has come up with some spodumene assets. There's Carolina. So there's potentially, like, I think, and Majigger Shah mentioned this, that America, could be an exporter of lithium chemicals by 2035, in a similar way that we thought we were going to be. We built all these LNG terminals to import LNG, and then we kind of like reversed them because of all fracking and horizontal drilling and unconventional, oil and gas enabled us to be a net exporter of that. I'm optimistic that North America can achieve that. But the question is, I don't know if you have two-tiered pricing or what, but which of those areas is going to be economic, right? Like most economic, like that makes sense, because right now we're pursuing all of the above. Rio Tinto is going to be in Quebec with, I forgot to even mention Nemaska and Galaxy. And Nemaska is kind of partly built already. And you have the Western oil majors. Sorry, yeah, the number of the Western oil majors in Arkansas, and you have now GM, and Ford, with both Ioneer and Thacker Pass. So there's an interesting kind of competition,
I think the other
among those
interesting
three
thing
areas.
is the juxtaposition, which I've seen Rodney mention before, also between incentive price and operating costs, because I think if the numbers that have been mooted by the developers are correct, the DLE projects in Arkansas are probably your lowest cost assets, followed by the sedimentary projects in Nevada, so lowest operating cost assets, followed by the sedimentary projects in Nevada, followed by the hard rock projects in Quebec. But in terms of the capital intensity, it's probably the other way around. So in terms of capital intensity, the Quebec projects have probably got the lowest capital intensity, and then the DLE and the sedimentary projects are much of a muchness. They're both quite high capital intensity, so you've got to think about it, as both operating and capital costs.
Why are the operating costs of the theoretical DLE providers in Arkansas and the theoretical sedimentary deposits? I say theoretical because right now it's all just spreadsheeted, versus, like, how could you say with high confidence that hard rock is going to be higher operating costs, number one? And secondly, there's also, I brought this up with Iggy 10 in our Lithium universe, all of the thought on hard rock in the West is that it's going to go to hydroxide, right? But why, most of hard rock is still converted to carbonate, in China, from Australia. So why wouldn't you make carbonate from hard rock? And why would it be? I can understand why brines in Chile are lower cost, right? And Argentina are lower cost. But how could you say with confidence that sediment and Arkansas will be lower operating cost?
Well, I can't say it with confidence, but based on the sort of feasibility work that's been published, the implications are that the sedimentary projects are in the first or second quartile of the cost curve. And based on the conversations I've had with DLE developers, again, the implications are that DLE production is in the first or second quartile of the cost curve, whereas the hard rock is generally been further to the right, shall we say.
Okay,
But I can't say it with confidence. I can only say based on the numbers that have been released by the developers.
Okay, so basically you're saying hard rock have proven numbers because there are a lot of hard rock assets in development, so you could have much higher confidence. And now you're having, if you can't believe, people are saying you go to China, you can't believe what the Chinese are saying, right? Why should you believe what a junior miner in Arkansas or a junior developer in Nevada, even if it's an advanced development project, is telling you? How could you, like history has proven that these things are higher capex, higher opex,
Yeah.
delayed,
I mean,
etc. Right?
certainly, history has proven that. I mean, I guess we'll see. I mean, Eramet are in production in their DLE project in Argentina, coming into production at the end of this year. So I guess we'll find out what the operating costs are for DLE. Of course, the caveat on that is that this is a salar DLE project, and how much more or less is a geothermal DLE project, and then that we don't know. So all we know is that the feasibility work that has been done implies that the costs are lower, but I cannot say it with any degree of confidence.
Okay. And Matt, now as you bring up Aramet, because this was a point of debate on my bull bear debate with Chris Robb at Benchmark, he was suggesting, look, DLE is working. Aramet paid a nice high price to take out Tsingshan. My take was Tsingshan, was very happy to get out with a small profit, because this thing may not work as well as they expect, right? Because Tsingshan is they've disrupted the nickel industry, and this was a foray into lithium. Like, why are they running out of lithium so fast? But what's your thought on that debate?
Well, there's two sides. There's either your side, get out while you can, or there's the side that, Eramet were like, well, we want to take out the minorities because we're really excited about this project. So I don't know. I guess the proof will be in the pudding. But the fact that Eramet paid what in the current market conditions is probably a little bit of a premium, suggests that they were more confident than Tsingshan was downbeat about it. I don't know.
We're suspecting that Tsingshan had a put right, in their original investment, and Eramet was forced to do it because Eramet was always shopping that project because they didn't have a good balance sheet. Their balance sheet's not that great now. For them to have kind of like taken on to do this, to me, it smells a little bit. Anyhow, the industry is growing overall. Lithium, it's 1.2 million tons. There's a lot more players, government players and oil and gas and Silicon Valley backed DLE providers. So it's an interesting mix. I'll talk about that separately, maybe on a rock stock recap with Rodney. But Matt, really appreciate your taking the time as always to share your very good insights. You said you're going to be wrong 30 to 50% of the time. I'm rooting for you to be wrong, with respect to how long this bear market is going to be.
Magnitude and timing. You'd like me to be wrong on magnitude and timing, eh?
Exactly. But, we shall see.
Given that I'm 100% leveraged to lithium in my business, I'd like to be wrong on magnitude and timing as well.
Yeah, we all. It was interesting. You commented. The last thing I'll say is I listened to your podcast, and Cormac O'Leary was saying his business was booming, and you were kind of saying that like you wish you could say your business was booming, and we're feeling like your side of the camp. But what's interesting is that Cormac and a few other players in the industry who have also said business is booming. I think there is really and this has been confirmed by a number of conversations that we've had with some OEMs and some oil industry people are really trying very hard to understand the cost curve and the overall supply dynamics here. So that there's still, the industry is growing fast, but like real money, like to get from 1.2 million tons to 3 million tons or 4 million tons, a lot of money needs to be spent. And a lot of projects do need to come online. And we're in this bear market where, like, you know, we did speak to an oil major who basically said, to the point we were just talking about, you know, we're going to come up with the real cost, the real capital cost, right? You know, because the feasibility studies that they've examined are not, you know, real, you know, costs. So that's a CapEx question. You know, on the OpEx side, we shall see. Anyway, thanks a lot again, Matt, and look forward to
Pleasure.
talking soon.
Cheers.